9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We're counting down to the open of markets in Greater China as we approach the Friday session. Last one of the week. Here's the approach. Oil down. Stocks are trading cautiously. That's amidst, of course, investors digesting this barrage of headlines coming through on the Middle East. President Trump says the U.S. may clinch a permanent ceasefire with Iran, with talks possibly resuming this weekend.
Also ahead, TSMC stock in focus as it raises its revenue outlook for this year with a 58% profit surge, underscoring the resilience of AI demand.
Plus, Kewichow Moutai posting the first annual sales decline since its listing on weak consumer and corporate demand.
And I'm Stephen Engel at the Hong Kong Exchange, where one of Hangzhou's so-called six little dragons of AI startups is set to begin trading. Manycore Tech is raising more than $150 million in its IPO.
Manycore Tech, that certainly is one thing we're watching, and many core themes that are coming back into this market,
I like
right?
what you did there.
Comes to, markets continue to price out the possibilities of more conflict in Iran. So certainly, it gives us more time as we talk about this whole week about the tech space. Certainly, TSMC just coming online here. We'll see how those earnings do react. But certainly, there's a lot of, optimism as we head into, of course, weekend possibly talks there. But also, you're talking about a lot of superlatives across these markets in Asia, too.
Yeah, I think the Nikkei hit a record this week. Taiwan was at a record. We're very close in Singapore. We're very close in Korea. Volumes, though, are still on the lighter side of things. And obviously, this TSMC at the open, we're looking at initial goings of down about 1.5%. Likely to take a slightly back as far as that benchmark goes. But yeah, the direction of travel has been towards a normalizing of market conditions. Not all. I think when you look at the VIX, for example, we're back to 17. Oil is back below 3 digits. I think gold is up for a fourth straight week. Dollar is down for a third. And of course, depending on which equity market you look at, we are either at near record highs and we are also approaching these record streaks. But yeah, I think the other thing to point out, though, is it's still unclear whether a deal will happen. And I guess when you look at things like how far between, the gap between the two sides, it does indicate that, while the direction of travel does remain fairly clear, we could be here for months based on some of our reporting as well.
Yeah,
right?
Some of the Gulf, Arab, and European leaders were talking about 6 months.
Yeah.
That's how long it's going to take to actually come up with some sort of peace deal. So what happens in the midst of that? Can you still see, as a normalization, as you say, like we don't have a return to fighting, and we continue to see the Strait of Hormuz maybe allow a bit more, vessels to go through, but certainly that's still up in the air here right now. But yes, we did hear from President Trump here saying that D.C. is going to make a good deal with Iran as the two sides discuss an extended truce. The current ceasefire expires next week, and U.S. Defense Secretary Pete Hegseth says the U.S. stands poised to restart military action.
We are reloading with more power than ever before, and better intelligence. Even more importantly, better intelligence than ever before, as you expose yourself with your movement to our watchful eye. We are locked and loaded.
Let's bring in Bloomberg Politics editor Laura Davison. Locked and loaded, according to Pete Hegseth. But what should we be looking at as we approach the weekend here, and possible talks that could be happening too?
We are yet again seeing the administration sort of keep all their options open. You have Trump saying, a peace deal is just around a corner. We may not even need an extension of the ceasefire that is set to expire here in just 5 or 6 days, and that this deal is going to be great and it'll include free oil as well as the opening of the Strait of Hormuz, and Iran's going to give up their nuclear program, which sounds like a great deal if you're Donald Trump. That may not be a great deal for the Iranians, and they have, not publicly, acknowledged that this is a deal that they're coming together. Sort of the question now is, are there going to be talks? When are these talks going to happen? There's been lots of discussion about this weekend sort of being a potential benchmark. Just getting these talks together, though, you've got people coming from different sides of the globe. You need at least, a day or so heads up for people to physically get in place. You have this deadline that's, set to expire on the 22nd here in Asia. So this is they're kind of up against the deadline here, and really sort of the the best case scenario, despite what the U.S. president has said, is an extension of this ceasefire, whether that is, a longer term thing like European allies are suggesting they might need, or a 2-week deadline or a 2-week extension, which is what sort of the previous discussions had centered on. But this sort of suggests that, this is again, in the beginning phases of a long process, not on, the 5-yard mark of something that's about to finish.
Tell us more about what we know in that 6 months and the timeline and what the conditions in the interim might look like. Actually, will the street be open? Is it business as usual, or is it more of the extremes while they work out that deal, which could take, based on our reporting, 6 months?
So that is the big question, because if the strait remains as it is, essentially with the U.S. blockade, with Tehran not letting much in or out, experts are warning that this could spark some sort of food crisis, a humanitarian crisis, and that you see prices spike. So that is a real pressure point to, have there be some sort of flow of traffic through the strait. But what that looks like, what is allowed, what kinds of cargoes, what ships that are connected to certain countries, that is all very murky and very hazy. But that, sort of crises have a way of allowing certain things to happen. But how the U.S. would feel about that, and Trump has been very much of the opinion of the U.S. if they're not affected by some of these pieces, that he doesn't care, and that's on Europe, that's on Japan, that's on other allies to come to the fore and fight that out. So this could get very messy very quickly, with very, very high stakes of people starving.
We haven't even spent a lot of time talking about that, which I think we should. Laura, thank you. Laura Davison there, of course, a politics editor. The longer we're here, it's the more serious that humanitarian aspect than if not already. But as markets go, they look through this, and when you look at where we are in prices, for example, the Nikkei we mentioned, that's at a record. We are now set to erase, according to when you look at the EM benchmark itself, set to reverse completely war-induced losses. We talked about this dollar is down for a third week. This term premium on oil is largely back in range, and gold, which has acted like a risk asset, is up now for a fourth week. Mark Cranfield is with us right now to take us through the direction of travel. Mark, it's certainly this week, going into this weekend compared to last when it was the negotiations that were front and center. How do we need to be thinking about the next 3 days as far as markets go?
Okay, so the setup is that the investors are largely assuming there's no backtracking. As Laura pointed out quite rightly, the ceasefire deadline does come up next week. That is certainly important. But you can tell from the way that the market is behaving, it's assuming that either there's going to be an extension to that ceasefire, or miraculously there'll be a deal before the ceasefire the deadline even arrives. They are not pricing at all for the fact that there'll be a return to the military action that we saw in the middle of March. That is not the base case for global investors at the moment. So obviously, should anything like that happen, you can see markets would reverse very, very quickly. But that's not how people are playing it right now. And as you say, most of the markets in Asia have reversed most of the losses they had during that period. Some are even gone further ahead. And now we're getting into a situation where if we get through this weekend without too much disturbance, it's going to be about rotation. It's going to be about people now looking for catch-up trades. From several of the themes in AI and tech have moved further ahead. Obviously, some people have been left behind. If you look at the index gauges, MSCI Asia Pacific has left the Hang Seng Tech Index in the dust. So clearly there are some Chinese tech names which look like they have relative value compared to the rest of their peers in the region, even within the deep tech story. So there's now a situation where investors are probably feeling a little bit more confident about looking ahead for the few weeks, few months ahead, and seeing, okay, which individual stocks need to catch up, which sectors have been underpriced, where can we adjust our portfolios. It's more now about managing a positive risk outlook rather than being defensive as they were back in the middle of March.
Yeah, as you mentioned, right, this could still go on despite what markets are pricing in. What do you think are the sort of the biggest risks to that sort of narrative that's building up right now, Mark?
It's probably within the bond curves. I mean, the bond markets have adjusted to expecting that inflation will stay higher for longer. It's a question of how much inflation and for how long. There's a G7 World Bank meeting going on at the moment. There have been lots of central bankers have been talking. there's this wait and see approach. The theme from all of them, whether it's the ECB, Bank of England, Bank of Japan, everybody seems to be in wait and see mode, which is understandable. We've had a shock. Inflation expectations have risen. Oil prices are higher, but we're not quite sure how long it's going to stay in that situation. Central bankers need more time to digest all this information. The risk for investors certainly is that they do what the Reserve Bank of Australia has done and Singapore. They start tightening quite early. That is not on the cards for the moment. It looks as though European Central Bank, Bank of England, Federal Reserve will all stay on hold for the time being. But markets are certainly not pricing for aggressive interest rate hikes from the central banks. As long as that stays the case, it's a very good situation for equities. If central bankers start turning a bit more hawkish, bond curves start steepening, that is something that will disrupt equities, not just in Asia, but globally.
Mark, just a quick word on TSMC. We're down following, of course, what happened in ADRs overnight. What's the slant that markets are taking post-earnings?
Actually, in a way, it's quite reassuring. The expectations are pretty high. TSMC largely met it. Stock come down a small amount. That's a massive contrast. A year ago, anytime a big tech company only just met expectations or the outlook wasn't perfect, stock got slammed. It'll be down 10% the following day. To see TSMC down only 1.5% today, really, that's pretty bullish, actually. That could reverse pretty fast. And as people, Anthony Stevens likes to call it the deep tech story. As long as that is being pervasive across Asia, it won't be too long before the stocks reverse. A 1.5% decline is nothing in the context of a big tech market.
All right. Mark, thank you. Mark Cranfield there in Singapore for us. In fact, just on that very note here, we will be taking a closer look at TSMC. We've had a flurry of reaction from the streets. The company, of course, raising its 2026 revenue outlook in a reflection of strong AI demand.
Plus, we're going to speak to the co-founder and chairman of AI startup Manycore as it debuts in Hong Kong after raising more than $150 million in its IPO. They are, of course, one of the little dragons, the first of the six to go public. We got the open of that, and of course, the trade in Shanghai, Shenzhen, and here in Hong Kong. Happy Friday. This is The China Show. Looking at TSMC stock here in Taipei this morning, we are seeing the shares down about 1.7%, sort of mirroring what we saw with the ADRs, despite the fact that results were a pretty strong quarter, right? So they talked about it was a beat when it came to the results. Outlook also was guided higher for 2026. So maybe it is kind of a sell in the news sort of factor that we're seeing here today. Let's bring in Masahiro Wakasugi, our senior industry analyst at Bloomberg Intelligence, who covers TSMC. So I mean, it was another strong quarter for TSMC. What stood out to you this time around?
Right. If we look at their revenue guidance for 2026, it was revised upward, which is a good thing. And the second quarter revenue outlook is also quite good, expecting 10% sequential growth in Q2, which compares with the historical 5-year average of 6% quarter over quarter. So I think that their business environment is quite good, and more importantly, their gross margin outlook is quite strong, and they achieved 66% gross margin in Q1, but they are expecting a further increase to the 66.5% in midpoint. So despite the current, tough inflationary environment, they are managing the profitability as well. So that's quite interesting point for TSMC.
What about in the earnings call? Did anything stand out? What were the main discussion points there?
Right. So the company was giving us a quite relieving point about the procurement for the key materials, including helium or hydrogen. And it seems like TSMC is well managing the procurement, and there should be no near-term disruption for the procurement. And also TSMC is still talking about their tight supply, and they are trying to keep the strong, trying to meet the strong demand, and their supply is not really, meeting up the strong demand. So they are talking about more capex going forward to supply more chips for the AI customers.
And it seems like there's just a lot more optimism in the chip space here. We saw the SOX index in the U.S. was up for a 12 straight session as well. So what are some of the broader implications that you're seeing for the tech sector based on these earnings?
Right. So it seems like TSMC is talking to its customer, and they were saying that the cloud service providers, and they were providing TSMC with a strong outlook, and which seems to be the multi-year demand outlook. So TSMC has quite confidence on the AI demand going forward, which is probably good for the whole tech supply chain, including the materials or equipment or memory chip makers, including Samsung, SK Hynix.
All right. Masahiro, thank you. Masahiro Wakasugi, there are Bloomberg Intelligence senior industry analyst in Tokyo for us for their take on these earnings. We're down ever so slightly there on TSMC, which I think is also the case when you look at the approach to the opening bell here in Hong Kong and in mainland China. We're also watching, of course, several trading debuts in Hong Kong today, including Manycore, which is set to give us its initial pricing in about 90 seconds or so. Lots more ahead. This is Bloomberg. Welcome back. Going into the open today, final session of the week. A couple of things to watch. Really strong momentum in the A-share markets. China's index is the best performing Asian benchmark over the last 5 days, so we'll see what happens with that. 3% pop yesterday. Manycore is a trading debut among several others today. We're keeping an eye on that, of course, in a moment. We'll talk about... So casinos, by the way, we had some data coming through out of the industry. Oil because of the declines, chips because of TSMC, and of course earnings is on Kewichow Moutai.
Yeah, it wasn't too pretty when you take a look at that. But let's get to Manycore here. I believe we're about to see some live pictures out of the Hong Kong Exchange. Many gains for the company here. As we talk about, it's one of the 6 little dragons in China, the first to go public. Look at that, 171% on the first day of school. So certainly a lot of optimism. What an interesting story, though, right? I mean, this is a company that really started off with home renovation assistance. Really that rode that wave during the property sector back in the day, which was once sizzling, but now has really pivoted this whole business, this software unicorn, into betting on robotics, into AI. So it's a bit of a second act for this company, and what a second act that we're seeing here.
Yeah, well, let's see what they do with that money. It's a good start to the second act, right? And I think it's a really good pivot from the company here. I think we'll get more really from the boss of the company. Will be joining us, of course, later on in the show. In the meantime, of course, the other... this is more OG than Manycore. Kewichow Moutai posting its first annual sales decline since 2001. That was the listing back then. Of course, you have weak consumer demand and also corporate demand weighing on the top line. Min Lo, our China correspondent, is big on Kewichow Moutai. Of course, how big was the sales decline?
I can't drink a Kewichow Moutai. It's too bitter for me. But yes, the decline was small. I would say it's a 1.2% decline on sales, 4.5% decline on net income, but still very significant given this is the first decline in about 25 years. And the company has been struggling over the last few years. You look at its wholesale prices, last year was at a record low. It fell by about 30% over the course of the year. And a part of it is the macro overlay, right? The slow consumption. But another part of it is the government's austerity campaign. It's been telling officials to cut back on spending. It's banned alcohol in this government-related banquets, for example. So many of these companies, not just Moutai, but the smaller Baiju companies, they have been struggling. And I've been speaking to mall operators in China. They tell me that their VIP gift cards, for example, have been hit hard as well. So it's all of these corporate entertainment related sort of spending that has been hard hit. Moutai missed its own growth target of 9%. And I think if you're long Moutai, you really have to think about how this fits into the national strategy, because I think this article on People's Daily is quite telling. If you pull up that quote, end of last year, it said that China's iconic luxury liquor is losing its place at the table. Wholesale prices fell sharply. It's a rare reversal for a brand once treated as an investment and is now returning to more rational pricing. So does this mean then that perhaps this could be the peak of Moutai's growth in China, and perhaps like the EV players, they have to go overseas now?
Wow, put down the glass. It's interesting, but they did raise prices of the Feitian just a few weeks ago, right? I mean, what are sort of strategies are they looking at to really lift sales now?
So lifting prices is one. They hiked prices of their Feitian, and they had guided, suggested retail prices to be higher as well. Late last year, we understand from Shanghai Securities Journal, they actually tried to stabilize market prices by putting a pause on their supplies to distributors for a short while. But over the last few years, it had been trying to get to the new customer segments as well, like the younger customers. For example, you had seen the collaboration with the coffee, Luckin Coffee,
yes.
Moutai Coffee, and also when it comes to third-party dealers, it's been tightening control there, and it's expanding its own direct-to-consumer channel. So it has its own iMoutai app. It's been collaborating with the likes of Taobao, Meituan for instant delivery. But of course, going overseas is one of the strategies there. It's expanded into the UK last year. I think they had a pop-up in Marina Bay Sands in Singapore last year as well, and it's able to command higher prices in Singapore, in markets like Singapore.
Okay, well, that runway is longer currently, of course, in the overseas markets for of course, such an OG brand. Min, thank you so much. Min Lo there, our China correspondent. Right, so Moutai is really one of the stocks we're tracking. We should get initial pricing on that in a moment here. Other things we're tracking here, of course, Manycore, we talked about that, a trading debut today. We're up 170% in the pre-markets. That, of course, will be up and running in a couple of minutes once we do have the opening bell, which I would imagine will coincide with the banging of those gongs on that stage. Casinos, and sorry.
I was just saying, Victor Huang, the co-founder, is going to be joining us, right, to talk about this rebirth of the company. And I certainly, Steve's going to be on the ground there at the Hong Kong Exchange to really talk about that. Let's get to, Macau casinos aren't doing anything right now, but let's look at Moutai. After what we saw when it came to those weak sales prints that we talked about here for the earnings, there you go. We're down more than 4% here, the first revenue drop since, of course, that listing. So certainly it is a big deal here, and what more they can do, given, as Min has said, the policy directions and the like is not in favor of this company. But yes, is this going to be a telling signal of what the rest of the industry is going to perform? That's going to be a key question, too.
Absolutely, yeah. It is the bellwether of that. Wu Liangye, Lu Zhou Daojiao, of course, some of the other booze makers in focus there. So we'll look at the entire cohort once the markets open up. And just given the weighting of the stock on the CSI 300 consumer staples and the benchmark itself, this should be a decent drag on the market. We're going into the open today. Some weakness coming through. The opening bell is just ahead. Welcome back. You're watching the China Show. Another sign that markets have somewhat moved on are these live pictures coming through, this proverbial popping of the percussion on the Hong Kong exchanges, and we are set for, of course, trading debuts here today.
Yeah, we haven't done this in a while, right? Going to these live pictures, the several gongs on stage here, certainly amidst all this volatility. But yes, there are still optimism around the tech space here, and one of them is, of course, Manycore Tech, as we talk about one of the 6 little dragons to go public for the first time here. And we're going to be speaking to the co-founder, Victor Huang, an NVIDIA alum, and really how he pivoted this business to all the policy tailwinds that we've been talking about, robotics, AI, and away from the property sector.
Yeah, and we'll see how they did it, right? And what really they bring to the table as far as AI concerned. Okay, let's listen in.
There you go. Manycore Tech among the others there. Another first day of school here, and we are already seeing that pre-market. Very, very punchy gains here when it comes to Manycore Tech. We are still up about, 170% here right now. Certainly, we're going to be asking a lot of questions to Victor Huang coming up as he will be joining Steve in just a moment here. But let's get a check on markets beyond just these listing debuts here today, because it is going to be a happy Friday if you're long these markets, given what we've been seeing, right? Asian stocks are set for a second straight week of gains here as we walk away from the whole Iran situation in some ways. But then again, we're watching when it comes to Chinex. That is the star performer here in Asia in the last couple of sessions or so. And there you go. You're seeing when it comes to the Kewichow Moutai, that's the one to watch. We're down 4%. When we talk about the poor earnings result here, that is bringing some of these liquor makers lower. Take a look at Wulangye, that's also down some 2%. So certainly when it comes to Kewichow, that's not a good news story here today. CATL, we're actually slightly lower here today. But then again, the battery stocks we've seen even in Korea are on fire here today. We take a look when it comes to what's going on CSI 300. We're slightly lower by about 1/5 of 1%. So not quite joining in on this rally that we're seeing across Asia here today. Shanghai crude is still a little bit elevated as we get closer to those Iran talks or possible talks this weekend here. But look at the Chinex. Shenzhen still looking pretty good here. We're up another 1/10 of 1% here. Let's take a look at how Hong Kong is shaping up, because a few themes, not just when it comes to Manycore, but we're also taking a look at when it comes to the earnings side of things here, right? But right now, tech seems to be a little bit on offer. We're lower by about 1/2 of 1%. Hang Seng is around that 26,250 level here. Alibaba is the only one that's actually seen some green across some of these big tech names as well. There is also the signs of, we're watching very much the property sector. We have Goldman Sachs coming through here after, of course, the new home price data that we got yesterday. There's thinking there's more of a recovery in the second half of this year. We'll get the Goldman take pretty soon in the next hour. Let's take a look when it comes to some of these stocks. So Macau certainly is one thing. Manycore is one. Let's get to SenseTime. Let's get to Ganfang Lithium first. These are one of the stocks to watch here this morning. SenseTime is lower by about 3%.
Yeah, it's a placement there.
Because of this placement for AI expansion, so raising about 3 billion Hong Kong dollars. Ganfang Lithium also said to be considering this green bond offering this month here as well. The stock is up some 3%. Macau casinos, this is what we're doing here right now. They weren't doing too much in the pre-market here, but there you go. Slightly to the downside today, despite some pretty good numbers in gaming revenue from the VIP space there from the first quarter.
Yep, up 35% on year. 1Q mass market gaming revenue plus 7.2%. So this one actually, when you look at many of the metrics in Macau, certainly back to, I can't believe I'm saying this, pre-pandemic levels, right? It took us that long, but here we are. Okay, Manycore, a couple of minutes into the session here as a public company, one of the Six Dragons, right? Yep, there we go. Of course, to go public, 162% out of the gates on that trading debut here today. Okay, I believe we are ready. Of course, Stephen Engel, our Chief North Asia correspondent, is in fact at the stock exchange, and he is standing by with the company's co-founder. Steve.
That's right. Victor Huang is a co-founder and also chairman of Manycore Tech. Thanks so much and congratulations on a successful debut. What a whirlwind year it's been for you as you've made this transition really from the 3D spatial recognition software company, a software as a service for the property sector, to the AI space. What kind of journey has it been for you? Because you told us in the last few months that, once the DeepSeek moment, you became, the world became aware of you. What's it been like for the last year?
Yeah, we have already focused on the spatial intelligence for almost 3 years, but it's a long journey until the DeepSeek become famous. Then a lot of people from all over the world to look at the AI technology from China. Before, people will not look at us. So I think it's our honor to be aware.
What's your biggest challenge right now? Because we do know the challenges for the physical AI and the robotics, and that is successfully navigating the physical world. How far are we away from having that kind of AI adaptation to allow the humanoid robots, where humans interact with the physical world intuitively? The biggest challenge has been to get the robotics to do the same.
Well, it's a good question. Just I think the biggest challenge is the top talent and the data. So we work on the physical AI. Then the physical AI has three parts. First is embodied AI, and it's linked with the hardware. And nowadays the Chinese robot, the overall world's robot, it's already performed pretty good. So the next part is the spatial intelligence. Is what we are working on. It's the spatial awareness, reconstruction, and generation. And the third part is the world model. It's nowadays very famous. Just you can simulation the world and you can predict the future. So that three parts combined together as a physical AI.
How important was it for you to take the company, which was founded in 2011 or thereabouts, which was really interior design software, 3D modeling and the like? How important was it to shift from that software as a service model, which is right now struggling? If you look at Salesforce, if you look at Adobe, they're struggling to adapt to the AI world and the AI competitors. How important was it for the success and the survival of your company to make that shift to AI? What is the moat that protects you?
Yeah, actually we start from the GPU to the cloud. Before I start up this company, I work at NVIDIA, work at the CUDA team. And at that time, I see the great opportunity to move the GPU from desktop to the cloud.
Yeah.
Then I need to find out the application. Then we can see when the software business is transitioned from this desktop to the cloud. So we grab the opportunity, then move the traditional software to the cloud. And nowadays the system was just improved. The new technology coming out. So we find out the large model will make the system smarter and smarter. So I think it's a transition from just the new GPU algorithm to make the spatial intelligence. I think it's pretty smooth. Just we grow together with the GPU just growth.
Now, where are the proceeds going to go? Because again, you're not yet profitable. You were profitable on an adjusted basis last year, but still you're likely to be in the red this year. You're going to be reinvesting this into what?
Actually, after we be IPO, the debt is disappeared. So we are profitable company right now. But we will still engage on the new AI technology. We will engage on the top talent. We will engage on the computing power, we will engage on the data, then we will explore to more market, like not only in the interior design, we will also explore the global market and also for the 3D content creation, for e-commercial, for short film. A lot of domain can use our new technology. Our new technology not only can support our traditional software, and also support our new software.
Well, how important is compute to you and processing power and having access to the most advanced AI accelerators?
Compute is really important for us, but we are more focused on just the cheap computing, just maybe the computing cost per token. We make it the cheaper the better. So we are not going to purchase the most expensive device. We are going to purchase the most just cost-efficient device.
Well, that's the trend right now with the agentic AI is the tokenization as well, because of the cheaper power, and you're able to leverage that and not necessarily have the most advanced chips from NVIDIA right now. Is that what you're seeing?
Yeah, you're right.
Okay, you mentioned overseas market. How challenging is that right now, given the geopolitical situation? There's war, that people are risk averse right now. I think a few months ago you mentioned about, it was in June when you and I met at the World Economic Forum in Tianjin. You said about 10% of your revenue right now, or then, came from overseas market, including Korea, Thailand, and elsewhere. What's your goal for international market percentage of revenue in the next couple of years?
I think for the long term, we hope the global market will dominate much bigger just percentage of our revenue. But I think the biggest challenge right now for us, for the global market, is the international management, especially for the people from different culture, different languages, different time zone. It's much harder than manage the people inside of China. So we still need to learn how to manage the global team. We have around 10 offices outside of China. That is already a big challenge. But after IPO, we will have branding, much better branding to hire the top talent from all over the world, from different countries. Because before, no one knows who is Manycore Tech. But now we IPO, they can check it on the list.
Right. So who's your customer list? I found your cornerstone investors to be quite interesting. One, you have a big insurance company, Taikang, but you also have Hesai. And I know David Lee and you are good friends, or you guys have come up through the industry very, very well. They're the LiDAR maker in vehicles. So the EV industry, robotics makers, who else are you really pivoting your new offering as page 2 of Manycore develops?
We all spend a lot of efforts on the physical AI part. I'm friends of David Lee. Then we often work together to discuss what is the future of the physical AI. Then we think we have great potential to work together. Then just they IPO before us.
Right. What kind of hiring and how difficult is it to attract and retain talent in the AI space, which is hotter than ever right now?
Yeah, right now the top talent is the hardest. It's really hard question, but we will try our best to we will get better salary, better environment, then better culture for the top talent. And we will try our best effort to attract the top talent to join us. And when we find someone is young but is super smart, they can report to me. Then I will have one-on-one with him just every week. We will make sure he will have idea. He will have his own idea to make something creative, and I will support the top talent.
How about the timing? I'm just looking at the price right now, up 163% on day one in the opening minutes. A lot of people say perhaps you priced it low. I mean, you priced it at the top end of the indicative range at $7.62, I believe it was. But again, a few years ago, you basically pushed aside the opportunity to raise funds, $500 million in the United States. Did you just find now was the best time to do it, even though the valuation was not going to be as rich as perhaps it was before?
Now we already be a profitable company. We want our investor to become profitable also. And so it's a happy day actually. The war is temporarily ending. I'm happy, our investor is happy, so that's great, why not?
Victor, great to see you. Congratulations on the successful listing, and we'll see you many times in the future as China's agentic and generative AI and humanoid robots develop. Back to you guys.
Fantastic interview there. Thanks, Victor and Steve, of course, for that interview. And certainly the turnaround on this company certainly has been quite remarkable, to say the least. Coming up, let's talk a little bit more about Australia. The Treasurer Jim Chalmers tells us how the Iran war is set to hit inflation and growth as he prepares to hand down the annual budget next month. Our conversation from the G20 meeting in D.C. is next.
The situation will gradually improve, but according to our analysis, it can take up to 2 years to see the big chunk of the production coming back to the before war levels. It will improve gradually, but it will not be immediately coming back to the pre-war levels. And some of them may be even longer than 2 years, especially some of the LNG terminals.
Fatih Birol there, the IEA Executive Director, speaking to us from Paris on really how long it might take for this whole recovery in oil and gas. 2+ years potentially here. On the face of that, of course, we've been talking to Australian Treasurer Jim Chalmers, and he says that Australia is not changing its tax policies due to the energy shock from the Iran war. Chalmers hands down the country's annual budget next month, and speaking to us in Washington, also said he expects growth to take a hit.
like almost every country here at the G20 meetings, Australia is expecting to see higher inflation and slower growth as a consequence of this war in the Middle East, and that will play out not just in petrol prices and diesel prices, but also in construction costs and in other parts of our economy as well. We're very alive to that as we finalise our preparations for the budget. Housing will be a key focus in that budget. It has been of the government's first 4 budgets, and it will be a big focus of the 5th. We don't have enough homes in Australia. We're very focused on making sure that we can build as many homes as possible to deal with this shortage, which has built up over a long period of time. And that has an intergenerational fairness element to it as well, which we're focused on, to make sure that we can get more people into home ownership and that there are more homes and more affordable options for people to choose from. So housing will be a key focus in the budget, as it has been a key focus of our government throughout.
Let's drill down a little bit more when it comes to energy, because it's my understanding that there's been a lot of discussion in Australia about raising more revenue from resources like natural gas, including a potential 25% export tax. But I'm wondering, does the backdrop of a global energy shock and war in the Middle East make you reevaluate Australia's trade relationships when it comes to the context of energy exports?
I think it's a really important reminder of just how crucial these trading relationships are to Australia. You know, just in the last few hours, I've met with countries which provide more than half of Australia's diesel imports and around 3/4 of our petrol and aviation fuel imports. And the message that I've been able to deliver to them, which I'm happy to repeat on your program, Tyler, is that we haven't changed our policy on taxes on LNG and energy. We know how important it is that we continue to be a reliable supplier. We have international obligations. And as we put the budget together and we consider all of these suggestions that we get, often quite diverse range of suggestions, we won't be doing anything that threatens those trading relationships or those supply relationships. I've been communicating that directly to our major trading partners here in Washington, D.C., and we've been communicating that publicly as well.
Well, I'm glad that you brought up these conversations you're having, because this White House, of course, has hit Australia with tariffs. President Trump has recently criticized Australia for failing to support the U.S. when it comes to the war in Iran. I'm wondering, in just the final minute, can you give us any more insight into what your conversations this week have been like so far with U.S. officials here in Washington and the response to President Trump's demands?
Well, as you know, the United States is hosting and chairing these G20 discussions, and so Secretary Bessent has been in the chair this morning guiding this conversation. It's been an opportunity for each of these major economies in the G20 to compare notes, to talk through their forecasts, their expectations for how this fallout plays out in our own economies. And so the Americans have been not just a key part of that discussion, but leading and hosting and chairing that discussion. Been an opportunity to provide our views there. Now, more broadly, when it comes to decisions taken here in Washington, D.C., Australians didn't choose the circumstances of this war in the Middle East. From an economic point of view, we want to see an end to this war because Australians are paying a hefty price for it at the petrol bowser, but more broadly as well. There are good economic reasons to see this ceasefire stick and to see the Strait of Hormuz opened. And if and when we can see that happen, we know that this economic fallout will have a long tail. And so that's another way of saying that these engagements are a really important reminder of how high the stakes are, how damaging these developments are for countries like Australia. And they really focus the mind as we put the government's budget together and hand it down in less than 4 weeks' time.
Jim Chalmers there, of course, the Australian treasurer, with our Tyler Kendall, that conversation. By the way, if you want to just watch that back or others that you might have missed here, the Bloomberg Video Hub, subscribers can explore live streaming, news, interviews that you might have missed, all our Bloomberg TV shows, reporter analysis, documentaries. Check it out, bloomberg.com/videos.
Here are some of the stories that we're tracking for you this morning. Netflix shares fell in late trade following a second quarter forecast that missed expectations. The streaming giant expects earnings per share of 78 cents per the current quarter period, below the 84 cents predicted by analysts. Now, also announced that its co-founder and chairman Reed Hastings will step down from the board after 29 years to pursue personal interests. The results are the first since Netflix walked away from the Warner Brothers takeover battle.
Our teams were more than up to the task. We've learned so much about deal execution, about early integration. We're really proud of the teams that did all that work. We were proud to win the bid. We are confident in our ability to get to the finish line with regulators for the approvals that we needed. But mostly, we really built our M&A muscle. We met a bunch of great people in the WBD during this process. So if there's any emotion in all of this, it was the disappointment of not getting to work with those folks.
And Bloomberg has learned that SpaceX has moved up employee share vesting to as early as next week. Now, sources tell us the company informed staff that the vesting date would be in April rather than May, as previously expected. The accelerated timeline is aimed at easing concerns over how much equity staff can sell ahead of its highly anticipated IPO, which is targeting a valuation of over $2 trillion.
Right, so just looking at cash markets, CSI 300 is flat. Volumes are extremely thin. It's really, though, in the Chinex index, and as you can see, that rally continues up 1%. Volumes are also on the heavier side of things. We have lots more on the way here in the second hour of the China Show.
Welcome back to the China Show. Yeah, we're taking you live pictures out of Shanghai, but all the action seems to be happening across the border where we are right now in Shenzhen. Take a look at the Chinex. We are at session highs here right now, close to 1% gains here, and really one of the best performers in Asia for the past 5 sessions. A lot of that has to do with the CATL story, just given their earnings this week as well, but also small caps are doing quite well in this market, Dave.
Small caps, tech, in fact, it's not very obvious when you look at the index level itself, because you actually have, a lot of these big tech plays in the Asia market leading, seeing substantial gains, 4 to 8%. But then you have, of course, the Moutai offset, which is really weighing on the benchmark itself. So you have Moutai coming up. That's also pulling down some of the other peers in the liquor industry. We're down 4.3 on Moutai. Where is Moutai? Oh, 3.4 on Moutai. SenseTime, that's a placement. Meituan is also getting pulled down. Manycore, of course, is that big listing here. Trading debut here today. We are coming off highs of the day and just up 163%. TSMC reporting earnings as good as almost what the markets were expecting, if not better. But the markets are selling this ever so slightly, though, down about 2%. The rest of the tech space on your screens. But I think the point is we are going into this weekend somewhat with more signs of normalizing.
Yeah,
across the markets,
even with a drop of 2% on TSMC, seems big, but when you take a look at how some of these tech, big names and tech giants have reported, if there is something that's just in line, we've seen much bigger declines.
Yeah.
So as Mark Cranfield and the MLive team said, 2%, we'll take it. It's actually not bad in terms of that reaction, given the fact that results were actually a beat. Also, they guided higher when it comes to revenue. So certainly it's still looking pretty good for 2026 for TSMC. And as you say, it gives us more time to think about, yes, are we returning back to normal, right? When you talk about what's going on with the dollar, right? We're heading for a third straight week of losses. Gold is coming back in a big way, despite the fact that it didn't behave like a safe haven during the whole Iran situation. And EM stocks, for the most part, are erasing some of the losses that we've seen since this war erupted, right? And that oil term premium, we're seeing less volatility there as well. Yeah,
we've come from very extreme levels to the downside. In fact, that's going to come up. So the term structure is when you look at the effectively front end and the back end. And as you can see, we're pretty much back to range. It's not back to normal programming just yet. Obviously, perhaps the gap there would be, I guess, the difference between where we are and where reality will be in 6 months based on our reporting. In any case, of course, from a macro perspective, the direction of travel is very, very good. And I think we've had some reporting too, just on the hedge fund front, right? That April a lot of the big hedge funds are doing well after just getting waxed in March, and I think that's the macro picture for you. Lenting Tu is with us. Our managing editor for Asian equities is with us out of Singapore. So yeah, Lenting, what is the story today? Why don't we start with tech?
Yeah, it is really about tech, about how animal spirit is back. Investors are reviving their pre-war playbook, right? It is, especially in China. You guys were talking about Chinax, and that index is full of tech. You know, we're talking about optical fiber makers, chip makers, and also energy storage names like Kettle. And if you look at earnings, these are actually backed by fundamentals. We saw chip makers such as Biren reporting a big surge in profit last week, and we saw Zhongji Innolight, which is a giant in fiber optical. They beat estimates yesterday. And if you look at Kettle, I think the data center demand proved to be very strong. So all of that is keeping investors distracted from the Iran war, like investors across the world. And of course, there's also a bunch of IPOs recently in Hong Kong that have been doing well. You guys mentioned Manycore. It's an AI sort of robotic thematic company, Little Dragon from Hangzhou. And the big debut is definitely offering people sort of a slightly different sector to look at, right? The data, AI data, it's a service as a company, and also a lot of AI-related themes. And yesterday we see SIG Energy also jumping a whole lot, and that is related to energy storage. Again, it's in demand from data centers. So yeah, plenty of things to again keep people distracted and excited about the AI theme.
Yeah. Is it all too rosy? I don't know. Given the fact that we still don't know what's going on with these Iran talks in the second round and the like, Lenting, where are you seeing the most in terms of flows here right now? Is this sort of rotation sustainable, right? I mean, Mark Cranfield was talking about there is a bit more rotation back into the value side of things. Tech certainly is the outperformer, but what are you seeing in terms of what analysts are telling you now?
Yeah, I think the big picture is rotation back into tech. If you look at North Asia, Taiwan and Korea are drawing money back again after record outflows that we saw in March. But also there are some bright spots within the kind of more value-oriented space. If you look at China, the brokerage space right now is being touted as a bright spot just because valuation is still below historical average. But if you look at performance, with CITIC Securities as an example, they reported preliminary earnings up 55% in the first quarter. That's mainly driven by a 71% jump in daily average trading turnover for mainland listed stocks. So, with animal spirit coming back, I think that is a sector people are continuing to be watching right now.
All right, Lenting, we got a bit there. Definitely watch the brokerage there. That is, of course, one of the taking stocks for today. Our managing editor for Asia Equities, Lenting Tu. As Lenting mentioned, right, there's a big listing debut here in Hong Kong today. Manycore got its start in China's real estate market, if you didn't know that. But the company has now pivoted away and betting on robotics and AI for its second act. And take a look at that second act, 162% on this first day. Let's get to our chief North Asia correspondent, Stephen Engel. He just spoke with the company's co-founder and joins us still live from the Hong Kong Exchange. What a story there, Steve.
Yeah, I think Manycore Tech sort of exemplifies what Lenting was just talking about, and that is this sudden reversal of towards more confidence here. Of course, there was a lull because of the last 7 weeks of the war in Iran, and of course also some of those restrictions, regulatory restrictions coming down from Beijing on overseas incorporated Chinese firms listing here in Hong Kong. So it was a bit of a dampener, but it seems like with Manycore, yes, they didn't raise as much as they would have if they had listed in the United States as previously planned about 3 years ago. They were aiming to raise about $500 million. This was $156 million, but it was 1,600 times oversubscribed on the retail tranche, 14 times oversubscribed on the institutional additional tranche. And as we've just been seeing, it's up 162%. At one point, it had almost tripled in the opening few minutes of trade. They priced it at $7.62, now at about $20. Obviously, the AI space is hugely popular with investors here in Hong Kong. We've had a number of other AI companies list before, Manycore Tech. But this one really sort of exemplifies a long company in terms of existence. They've been around since 2011. They were doing 3D software for the property sector, 3D imaging for interior design. They're taking that 3D data that they have and then switching it into the physical AI world. And, Victor Huang, the co-founder and chairman, says that DeepSeek moment last year, which they're one of the 6 new dragons, little dragons from Hangzhou, really changed their fortunes. Here's Victor.
We have already focused on the spatial intelligence for almost 3 years, but it's a long journey until the DeepSeek be famous. Then a lot of people from all over the world to look at the AI technology from China. Before, people will not look at us. So I think it's our honor to be aware.
So just in a nutshell, what they do is they'll take this spatial awareness from their 3D models for the physical world and basically translate that into the AI world for physical AI and robotics. We can navigate through a room pretty intuitively, right? But the humanoid robots have had a challenge. So again, it's getting that physical spatial awareness, spatial intelligence with the aid of AI into physical AI robotics, and that's the way they see forward for a new era of growth.
Steve, what else stood out to you when you, in that interview? You guys covered quite a wide range of topics. He looked very good personality. Yep. He smiled throughout the interview. Anything else stood out to you, Steve?
Well, they don't necessarily need to rely, like the large language models globally, on the high compute from the most advanced NVIDIA accelerators. Again, he came from NVIDIA. He worked at NVIDIA. But that's not necessarily holding them back by having those export controls from the United States. I'm sure they would love to have their hands on them if they could. But also, their international aspirations are quite large. Last year, I think they said they got about 10% from the international market. And big promising markets include South Korea, Thailand, even in the Middle East, and even in the United States. So that's those export controls, and if one would say the bifurcation of the tech development worlds between the United States and China is not holding Manycore Tech back, according to the co-founder. So obviously, with a very successful IPO today, they're quite optimistic. We'll have to see going forward, though. But there's lots of optimism in the AI space, especially among those 6 little dragons of AI startups coming out of Hangzhou. This was the first of those 6. That includes, of course, DeepSeek as well as Unitree Robotics to go public.
There we go. One of the 6 dragons. That's three short, though, of Kowloon, if you get the joke. Anyway. Stephen Engel, our Chief North Asia. Of course, did anyone get that? Okay.
Joe Long. Yes,
Long. Okay.
I got it.
All right. Coming up here on the China Show, Goldman Sachs head of China Real Estate Research joins us to really tell us that they extrapolate 2 cities to lead this recovery, Shanghai and Shenzhen. Lots more ahead with Yi Wang from Goldman Sachs in a couple of minutes. This is the China Show. Welcome back. Home prices in China. Let's talk about this, right? So we did get data this week. The declining pace of growth. The declining pace of losses, rather. Okay, the declining pace of losses, rather, cornered myself into that. Based on the latest home price numbers, slowest in around a year. Official data now shows new home prices down 0.2% in March, the smallest decline in nearly a year. Your real estate values in mainland China have been on a years-long slump, but some analysts actually now expect the market to to start showing signs of bottoming out.
Yeah, just like our next guest, Goldman Sachs is predicting that when it comes to some of these first-tier cities, it's Shanghai, it's Shenzhen that will lead this recovery. It's head of China Real Estate Research, Yi Wang, now joins us live from Shanghai. Yi Wang, thanks so much for joining us. Yeah, it is those tier one cities where we're still seeing when it comes to sequential home price gains. In some ways. Obviously, we've seen some home buyers easing measures in the last few months or so. Tell us what you're seeing. Do you think that the bottom is in, and is the worst really over now in this slump?
Yeah, I think that this is exactly what we try to point out in this report, that after 5 years of downturn, we finally see an inflection point leading by these Shanghai, Shenzhen cities with the strongest fundamentals. We highlight 4 key fundamental drivers for housing market recovery, and both Shanghai and Shenzhen sit at the best position among these 4 fundamental drivers.
Okay, and so tell us about the price projections. People are probably wondering how much prices are likely going to go up if you guys are correct for these 2 cities. So what is the projection?
Yeah, we're looking for a 15% price increase during the end of this year to the end of 2028. So with the 40% price decline from the peak level, basically we're seeing that this will reverse to a 30% down from the peak level. This is kind of similar to the magnitude that we're looking at, average of magnitude of a price decline. We look at global housing market downturns.
Yi Wang, just to clarify, the timeline is from the end of this year to the end of 2028, or was it from the end of last year, 2025, to the end of 2028? Just to clarify that.
Yeah, I think we're still in the stabilization stage. So we're really looking for an inflection point later this year. So it's not from end of 2025, but later this year.
I see.
Yeah.
So that's just 2 cities. I'm just wondering, when you look nationally right now, Yi Wang, is it just as promising? I mean, when you take a look at tier 2, even lower tier cities, I think housing stock is still at decade highs here right now. So can this broaden out this recovery?
Yeah, I think the importance of Shanghai and Shenzhen is that on a combination basis, both cities account for 20% of secondary market sales value or transaction value. Secondary market is the key swinging factor in this downturn in terms of ASP trend. So the early bottoming out of these cities obviously will have a lot of implications to the rest of the 2 tier 1 cities, as well as those stronger tier 2 cities. So we think that it's still quite important to highlight this inflection point to investors. Of course, there's still a lot of inventory pressure in many lower tier cities. But as we highlighted in the report, we're still looking for about 24 months of possible time horizon for these markets to eventually stabilize. Not price increase, but stabilization.
Which would be a good step, certainly, from the current conditions. What about other first-tier cities?
Yeah, I think actually, if you look at the Beijing, there's quite similar positive momentum year to date. But the reason that we highlight the Shenzhen and the Shanghai in this report is we see a very high property price correlation with Hong Kong. You all know that the Hong Kong property market already recovered for about a year. And based on historical experiences, Shanghai, Shenzhen, after Hong Kong property market recovery, will follow up in about a year time. That's the reason that we want to, highlight this critical timing of inflection point after seeing Hong Kong property market early recovery.
Interesting. I like the links there that you put, Yi Wang. We've seen these sort of policy-led rebounds before. I bring it back to 2023, 2024. But what happened was quite short-lived. Yi Wang, I hate to ask that question, but what's different this time that you think that there might be more of a recovery and runway here?
Yeah. I think if you look at the investors' focus, which we've been very clear about, their focus now increasingly shifted from policy to fundamentals. And that's the reason that we spend so much time talking about these 4 fundamental drivers, which are the key drivers for Hong Kong market recovery, will be also the key drivers for Shanghai, Shenzhen market recovery, which is demographics, income, supply, and affordability. So with all these, fundamental drivers aligning with the Hong Kong property market, we think that the conviction from us to see these 2 cities recovery is getting higher. And I think based on the last couple of days communication with the investors, most investors actually not asking about us, what kind of new policies that you think will be launched by the government, but more why you think these fundamental drivers are important for these 2 markets, how you come up with this 15% price increase.
I see. Okay, so the 4 factors, let's talk about that. Does the momentum across those 4 individually and collectively, do those 4 point to gains broadening out? And part of that question also is, I think you mentioned policymakers, have they done enough? And do they just wait until things, is it just a matter of time is my simple question.
I think the government policy measures or supporting policy measures is more on the local city level. If you look at the Shanghai and the Shenzhen, there's still room for both cities to further relax home purchase restriction. The government already halfway in relaxing this control. I think that this is maybe something on a city-specific level that we can watch for. But in terms of the 4 fundamental drivers, you see the immigration talent attraction program that help demographics in both cities keep improving. And on the supply side, actually, this is something that we think Shanghai, Shenzhen sit better than Hong Kong, is that the sellable supply actually already come down 20-30% for both cities from their peak level. And more importantly, if you look at the housing supply ratio measured as average households owning how many housing units, Hong Kong is 1.1, but for both Shanghai and Shenzhen, it's actually still below 1 times. In the sense that, structurally, there's still more housing units needs to be built in both cities with a population increase. I think that the only thing that Shanghai and Shenzhen lacks versus Hong Kong is a positive cost of carry, i.e. rental yield minus mortgage rate is still negative. But this is already the tightest level that we've seen in a decade time. And I think another aspect that we should pay attention is the rental yield against the time deposit rate. Okay? So if you look at the rental yield against time deposit rate, we are at the very 1% spread right now. So that triggers, I think, probably the reason why we're seeing secondary market listing supply decreasing for both cities, especially Shanghai. This has been decreasing for actually since last December. So this is a quite encouraging sign in the sense that people will wonder, after 40% of property price decline, should I sell now or should I actually looking for renting opportunities? As if I sell now, my gain by putting the cash into banks is really so tiny versus the almost 2% rental yield. So I guess this dynamics is also very important when you think about affordability for both markets.
Okay, can I ask you in 15 seconds, should I sell now or should I rent it out? What do you think? Just a broad, what's your
personal
take?
question?
Yeah.
I think maybe they will still decide to sell at the end, because we know that Chinese household might have multiple housing units, but just simply slowing down that listing supply can help near-term supply and demand dynamics in the secondary market, and that's very crucial for property price to stabilize in secondary market.
Asking for a friend. No, okay, you posed a question, so I just wanted to know what the answer was. Yi Wang, thank you so much, Head of China Real Estate Research there at Goldman Sachs. Right, lots more ahead here on the China Show.
Welcome back. We got some news this morning when it comes to the corporate side of things, earnings and the like. Wall Street banks are said to be tightening their arrangements with private credit funds amid the turmoil in global markets. Sources tell us that lenders such as JP Morgan and Goldman Sachs are exercising their right to write down individual assets while others are raising interest rates. The moves are adding pressure on private credit funds already reeling from an exodus of investors. Footwear maker Allbirds stock sank more than 30% a day after that near 600% surge as it announced a surprise pivot to AI infrastructure. Analysts have expressed skepticism about the company's move and the stock reaction. One calls it a Hail Mary, and another saying it has the feel of a meme stock, driven by emotions rather than logic.
Kind of feels like when folks added blockchain to their names a few years back. Victory giant A shares. Big win, if you think about it, ahead of the H-share listing next week. We're also looking at optical-related stocks in China, and as you can see, we're also looking at some gains. We referenced this earlier, but really seeing some gains in that space, masking the general weakness across on an index level.
.29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment. Asia Pacific is losing a bit of momentum. We're down about 0.9%, but I think it has been a pretty fruitful week as well when it comes to gains here. And really, we're talking maybe we'll still make it to 2 straight weeks of gains for Asian equities. Japan is leading that charge lower here this morning. As Dave mentioned, volumes are quite low, which is actually a bit surprising as well here today.
Very, very low. But yes, we will make it through the week with gains unless we collapse to about 2 or more % over the next few hours or so. It looks like that price will still get over the line. It's worth pointing out. So in fact, we had to relook at the calendar today because volumes are about 25% lighter than average for this time of the day. I almost thought that there was a market closed. It seemed, they're that light. Going into the session, the thick of things today, just looking at the benchmark, we are down and volumes are on the lower side of things. Stasis is, I guess, a good way to describe things going into this weekend. In fact, just volumes, right? Up 3 straight weeks. But as the chart's about to show you, volumes have swooned amidst this 3-week price rally. That's the bottom of your screens, and that's that blue arrow effectively showing you what a swoon looks like visually.
Okay. Speaking of really the swoon, or at least the surge, right? The shares of Manycore, a non-swoon. Shares of Manycore Tech have jumped on its debut here in Hong Kong after an IPO that raised $156 million. The co-founder and chairman, Victor Huang, says robotics is poised to be the next real estate. He also told us Chinese AI is gaining global attention now.
We have already focused on the spatial intelligence for almost 3 years, but it's a long journey until the DeepSeek be famous. Then a lot of people from all over the world to look at the AI technology from China. Before, people will not look at us. So I think it's our honor to be aware.
What's your biggest challenge right now? Because we do know the challenges for the physical AI and the robotics, and that is successfully navigating the physical world. How far are we away from having that kind of AI adaptation to allow the humanoid robots, where humans interact with the physical world intuitively? The biggest challenge has been to get the robotics to do the same.
Well, it's a good question. I think the biggest challenge is the top talent and the data. So we work on the physical AI. Then the physical AI has 3 parts. First is embodied AI, and it's linked with the hardware. And nowadays the Chinese robot, the overall world's robot, it's already performed pretty good. So the next part is the spatial intelligence, is what we are working on. It's the spatial awareness, reconstruction, and generation. And the third part is the world model. Nowadays it's very famous. Just you can simulation the world and you can predict the future. So that 3 parts combined together as a physical AI.
How important was it for you to take the company, which was founded in 2011 or thereabouts, which was really interior design software, 3D modeling, and the like? How important was it to shift from that software as a service model, which is right now struggling? If you look at Salesforce, if you look at Adobe, they're struggling to adapt to the AI world and the AI competitors. How important was it for the success and the survival of your company to make that shift to AI? What is the moat that protects you?
Yeah, actually we start from the GPU to the cloud. Before I start up this company, I work at NVIDIA, work at the CUDA team. And at that time, I see the great opportunity to move the GPU from desktop to the cloud.
Yeah.
Then I need to find out the application. Then we can see when the software business is transitioned from this desktop to the cloud. So we grab the opportunity, then move the traditional software to the cloud. And nowadays the system was just improved. The new technology coming out. So we find out the large model will make the system smarter and smarter. So I think it's a transition from just the new GPU algorithm to make the spatial intelligence. I think it's pretty smooth. Just we grow together with the GPU just growth.
Now, where are the proceeds going to go? Because again, you're not yet profitable. You were profitable on an adjusted basis last year, but still you're likely to be in the red this year. You're going to be reinvesting this into what?
Actually, after we be IPO, the debt is disappeared. So we are profitable company right now. But we will still engage on the new AI technology. We will engage on the top talent. We will engage on the computing power, we will engage on the data, then we will explore to more market, like not only in the interior design, we will also explore the global market and also for the 3D content creation, for e-commercial, for short film. A lot of domain can use our new technology. Our new technology not only can support our traditional software, and also support our new software.
That was Victor Huang, the co-founder and chairman of Manycore Tech, which debuts in Hong Kong today. Not a bad first day at school. Stephen Engel, of course, did the interview just there. Right, if you want to rewatch that interview, it's the Video Hub. That's where you go. Live streaming. You can scroll back some of the things that you might have missed here. So we talked about TV interviews, TV shows, report analysis, documentaries. Check it out, bloomberg.com/videos.
Welcome back. You're watching ETF IQ Asia, a special weekly segment that dives deeper into the industry. We're going to start with a quick update, of course, on how flows are doing the first quarter. Yeah. Of course, a big theme because this week have markets really moved on from the situation in Iran. Let's bring in our ETF analyst, Rebecca Sin, from Bloomberg Intelligence to help us track what's going on right now in the ETF world.
So the flows have moved on, which is positive. If we look across the flows for the first quarter, it's really been a theme of AI, tech, and chips. If we look across the board for the top 5 names that have seen the most inflow, the first one is Yuanta P-shares. It is the second largest holder of TSMC with a 63% holdings. And so, of course, that has done phenomenally well. It's the number 1 inflows across Asia Pacific with 6.3 billion, but it's also made the board across globally for number 12th ranked ETF. It's very, very rare that we get Asia Pacific on the leaderboards globally. But the next name after that is a China Grid. And as you may know, China is the largest supplier of power grids globally. The government just poured in 4 trillion RMB into this sector, and so we're seeing a lot of growth. And across ETFs, those funds have really performed 30 to 50% year to date. The third one is then Samsung. This is also a tech play. It's 30% biotech and pharma, 20% semiconductors. So we're really starting to see a lot of the AI and themes name. Fourth one is CSOP, Hang Seng Tech, no surprise there. But the last one is really fixed income. And as we look across the first quarter, we're really seeing investors starting to shift away from these AI and tech names. And really that's because tech names have primarily recovered with the positive in the war potentially ending. So we're seeing a shift now into these products.
And let's hope that continues.
Into bonds.
Yeah. Oh, there we go. So where are we in as far as some of the end of the Q1 data is concerned, right, in terms of this is the state of play across markets. Market share, by the way, which is divvied up based on AUM, as you go from Japan into mainland China, and of course some of the other markets there. Taiwan, Korea, and why don't we talk about Australia? Rebecca staying with us here, of course, on set. Joining us here to discuss really what the market looks like in Oz, Alex Vynokur, founder and CEO at Betashares, an Australian ETF-focused asset manager. He's here for the sevens, but he's also here to see us. Very nice to see you.
Great to be with you.
I know fixed income is perhaps having its time in the spotlight in Oz. I think we'll get to that in a moment. But tell us about what's happening in your market in as far as flows are concerned, given the last, let's call it 7 weeks.
Absolutely. Look, the ETF story globally is continuing to evolve. The volumes and the inflows into the ETF industry in Australia very much mirror what you're seeing in the rest of the world. The volumes are up. The inflows are very strong. The month of March, which of course has been a very volatile month for the markets, has seen the third largest net inflows in Australia on record for the ETF industry. So Australian, sort of investors and Asian investors and global investors are utilizing ETFs more and more to either manage risk or to take risk, basically, in areas that are finding of relevance. What we're seeing in Australia is very strong interest, wouldn't surprise you, in oil. The volume in the crude oil ETFs have significantly increased in March. People were, again, either taking risk or hedging risk using that ETF. But Australian and global equities are continuing to dominate the flows, basically. And we're seeing interest both from domestic investors, but as I mentioned, increasingly we're seeing interest from Asian and global investors more broadly, because in the sea of volatility, Australia has been a relative island of calm.
Island of calm, the characteristics of this ETF market seem to be the most similar, I would say, to the US. Why do you think that is? What's driving this shift?
That's a really good point. There's a very strong retail participation. That's number one. Australia has a very significant retail market. And the one little tidbit of information on Australia, even though we are a small nation in terms of our population of 27 million people, Australia is on track by 2030 to become the second largest market in the world for retirement savings, just behind the US. That is all due to our compulsory retirement savings system, which in Australia we call superannuation. That industry is compounding at a very significant rate of growth, and as I mentioned, by 2030 is on track to become the second largest in the world. So back to your question, we have a very strong retail participation in Australia. I mean, Betashares itself has more than 1 million retail self-directed investors. In addition to that, we have a financial advisor community which is predominantly independent. And independent financial advisors, not too different to what you're seeing in the US with RIAs, are significant adopters of ETFs. So when I started the company now 15 years ago, we hardly had any financial advisors utilizing ETFs. Today in Australia, over 2/3 of all financial advisors are utilizing ETFs, and their propensity to allocate capital to ETFs is actually increasing over time. And the reinvestment rate is over 85%. The vast majority of investors have a great experience investing in ETFs. And this is not just Betashares ETFs, of course. This is the ecosystem that I'm talking about. So we have a thriving market, which is growing at a compound annual growth rate of 42% per annum over the past 15 years.
So if we look across Asia Pacific, you mentioned you guys are the second largest users of ETFs after the US. If you look across Asia Pacific, we don't see that replication. Taiwan has a 73% retail adoption of ETF, but why do you think that is, and why do you think the rest of the market hasn't adopted what Australia and the US has done in terms of your superannuations and your advisors and your independent advisors?
Yeah, look, it's a great question, Rebecca. So there are a couple of things here. Number one, Australians need to invest globally in order to invest well. Opportunities, sort of growth opportunities of the future are really around the world. Australia is a phenomenal market. I'm, of course, a very proud Australian, but, we represent a very small percentage of the global opportunity set. ETFs really are the easiest, the most convenient way for Australian investors to tap global opportunities, whether it's global cybersecurity, global artificial intelligence, you name it, right? There's so many incredible opportunities everywhere. So ETFs becomes the vehicle of choice for retail investors. For advisors, importantly, Australia, over a decade ago, has gone through a period of reform where remuneration for recommending investment products has been changed, and advisors are not receiving any commission or any other form of remuneration from product issuers. So as soon as ETFs were allowed in Australia to compete on a level playing field against other forms of investments, that's really supercharged the growth in the ETF industry, and that really mirrors what you've seen in a market like the US. When conflicted remuneration and commissions are removed from the equation, ETFs really come into their own. They compete really well on a level playing field.
So domestically, what is more popular, domestic exposed wrappers, or is it one where Australians get an exposure to outside? And how does that affect your strategy in terms of your pipeline?
Well, look, I mean, we've had a really busy 15 years continuing to evolve our suite of products. Australia, like every market, is not a homogeneous market. Some people invest in very much core building blocks. And a number of investors are investing more thematically, in addition to building a diversified, cost-effective core portfolio. So the vast majority of flows in Australia from Australian investors are really going into global exposures. And what we're seeing also is a very significant growth in adoption of fixed income. So in the fixed income category, ETFs really come into their own. Bonds are very hard to access for retail investors. The minimum denominations are still very high. The ability to get diversification, to get quality execution through the ETF vehicle is really very compelling for advisors, for the retail investors, and increasingly we're seeing it for institutional investors, in particular from outside of Australia.
So active ETFs has been around in Australia for the longest. Why hasn't it picked up?
Look, my view on active is that ultimately the ETF wrapper is not the panacea against poor performance. If your performance is great, ETF wrapper can enhance your distribution capability. It modernizes your access to the market. But at the end of the day, investors who invest with active managers, and we have a number of active strategies at Betashares, where we've partnered with active managers to bring to market. At the end of the day, investors expect performance from active managers. And ETF investors in particular are very familiar with the alternative of investing in an active strategy, which is to invest in an index. So when an active manager under-delivers, basically, the alternative is very much available and is very much there. So what we're seeing in Australia is a real proliferation of active product. However, if you look at where the flows are going, the vast majority of flows are still going into index products. And the statistics in Australia, if you look at the S&P SPIVA reports, really mirror the rest of the world, where 75-80% of active managers in any given period tend to underperform net of fees.
Alex, it's great to have you in town here, and of course enjoy the weekend here in Hong Kong.
Thank you. Great to be with you.
Founder and CEO at Betashares, and of course our thanks to Rebecca Sin, Bloomberg Intelligence ETF analyst. Of course, you can tune in to the ETF IQ Asia every Friday right here on The China Show. We're bringing you more analysis and conversations with top market players and newsmakers. This is Bloomberg. All right, it's the Rugby Sevens, right? Kicking off here in Hong Kong today. It's a good time to focus, of course, on some of the more aggressive frontiers for global capital right now, which is, of course, the business of sport. At the HSBC Global Investment Summit, I sat down with guests including Oliver Weisberg, the strategic lead behind Joe Tsai's landmark acquisition of the Brooklyn Nets and the Barclays Center. Take a listen.
What's happened over the last 5 or 10 years, I kind of use the term liberalization of the sports industry. When we bought the Brooklyn Nets, they had to be individually purchased. Over the last few years, and I have two colleagues here in the industry who are running firms doing this, The leagues are now allowing private equity to get involved in sports, and there's a few things that have happened there. Number one, a trophy asset team that might have been owned in a small town may have some private equity at that point, and may have more professional management coming in. So we're seeing that across the industry, and we're seeing more capital, because in the sports industry, generally speaking, there was very little debt and very little access to capital and very little liquidity. So it's created this circularity in the industry now, where you have more sports owners, more professional management. And that's just created a better experience, more profitability, and so forth. So that's kind of what's changed in the last sort of 5-6 years.
Jeff, maybe you can chime in.
Yeah, I think the other piece of the evolution is sports used to be a very local business. So, 15, 20, 100 years ago in some markets, it was really about selling tickets to the match. Local fans would come, and that was really the business of sports. We've seen that evolve significantly. Local media rights, global media rights, all forms of content around these sports platforms and global audiences. And I think what has also changed is they become really large businesses. So just to put it into context, I think it's sort of helpful, and the numbers sometimes surprise me. The annual revenue of the sports industry every year is measured in 500 plus billions of dollars. There's $60 billion of media rights revenue every year, which is 2 times the worldwide box office for films. So these are big industries, they're global, and they've really allowed that macro trend paired with good fundamentals around the businesses.
Netflix really fundamentally changed, among other streaming platforms, how we all consume scripted content and unscripted content.
Yeah.
Everyone can watch it in their own way, on their at their own kind of leisure. Sports is really that last bastion of entertainment that brings everyone together in a communal way on an appointment viewing basis. And as you can imagine, that's really valuable from an engagement standpoint, both as a consumer, but also for brands that are buying inventory and are trying to reach a very engaged and valuable consumer. And I think when you couple all those things together with the kind of global reach that these brands now have and the multi-dimensional businesses that they all represent, that's a pretty powerful and pretty unique ingredient.
I mean, when you think about a global sports team, how many, maybe you can think about maybe 2 hands on teams and franchises that maybe have really reached that level.
This is a little bit of a plug for cricket. I think if you look at the global interest in cricket, really driven by the IPL in India, is expanding at a tremendous rate. There's interest in cricket in a lot of markets internationally. The players are international athletes, so they'll play in a lot of different competitions throughout the globe. So I think that's another good example of a global sport. They're building the business model around the fandom. So I think there's going to continue to see more commercially viable and revenue growth opportunities for sports like cricket, but they have global fans. The athletes are global celebrities. The engagement is tremendous. I think the opening weekend of the IPL this year, there were 2.5 billion minutes of cricket consumed.
Wow.
I think 450 million people watched the first IPL match. So the numbers, even relative to global football, soccer, and the NBA are quite large and staggering, and are growing at probably the fastest growth rates in any sport in the world.
Yeah, it was a fascinating discussion here, not just talking about the sports, the team investment, but also sports adjacent and how to make this a global sort of thing. And the NBA coming back to China certainly was a big thing that all the panelists were very excited about here, given they all have stakes and ownership in some of these NBA teams. Women's sports obviously is really good as well, but they're also talking about stadiums, and we got a big stadium that's going to be filling up a little bit later on today.
Yeah, because last year was the first sevens that was held at TAITAC, so this is the second iteration. 50,000 will be packing themselves into this high-tech stadium. Not that there's a shortage of space, but yes, it's going to be an extremely busy weekend here as far as the sevens go. So.
Oh yeah, I think they've arrived. The bars are getting ready as well. And what was this Man City and Arsenal match that we're going to watch out for?
Yeah, this is the biggest match of the season. Either Man City could lose, or Arsenal does it again, and they stop short of winning at the very end. Anyway, if they take it, Arsenal, then it's pretty much there. So this weekend's going to be jam-packed. We'll see you all on Monday.